For now, let's bring in the market panel. Joining us now, Wealth Enhancement Group Senior Vice President Nicole Webb and MUFG Head of U.S. Macro Strategy, George Goncalves. Guys, happy Friday. George, if the Fed doesn't deliver as many rate cuts as expected in 24, that could disappoint the market, right? But isn't that a second half thing? How should investors be thinking about these last handful of trading days heading into 24?
Look, I mean, obviously, markets have been buoyant and super excited about the Fed pivot, but you have to be careful here because it takes time to implement it. So if the Fed starts cutting rates later in the year and they actually have to go a lot faster, that's an issue. And if they don't cut early on, I think in Q1, people are going to be disappointed. I mean, they have to really start in March, May, probably June the latest. And I think if we don't get that, the bond market reverses, and that's going to really send some waves through other markets.
Nicole, you think that happens?
You know, I think it's one of these situations where it's the why behind the Fed cutting rates that's most important. And I think when we talk about the stickiness of the rally over the last couple of weeks, that for us is where we're getting a lot of clarity. So it's not that we had a collapse in the labor market. It wasn't that there was data supporting the need to go into easing. Instead, it's that growth appears sideways, inflation is easing, there's disinflation in the pipeline, and therefore rates look overly restrictive. And so when we think about that and the application of that to 2024, I think it becomes less about the timing and more behind the narrative of the why. And for right now, the why makes us a believer that there will be broadening to the market and that there is the prospect of, you know, the timing not collapsing the market, the timing not creating too much volatility, but instead giving more of a runway to positivity through 2024.
Now, Nicole, I know you think that S&P 500 earnings actually can show up in 2024, though there's a lot of question about that. And you think that productivity driven by tech is a big part of the reason why. But in a way, doesn't that mean layoffs? I mean, doesn't that mean companies are going to be able to do either just as much with fewer or maybe even more with fewer workers?
Yeah, and I think, you know, I'll say about myself, I might have been a little bit early to the productivity narrative, but that was the one thing that stood out to us all through 2023. And so with the acceleration of not just talking about AI, but seeing CEO sentiment shift to where they were confident in spending, they were bringing in the application of these technologies. I think when we look back at textbooks, this might be the era of the roaring 20s. It just showed up later than expected after years of really low productivity, looking all the way back to the 1960s. And so, you know, not only could productivity really increase margins, but I think also, you know, we might just have earnings per share growth that reaches a broadening of the market and also the capital deployment. And we're seeing a little bit of this already in the Broadcoms and the Qualcomms buying up these smaller technology companies. But if we do see a pullback in rates, we think that that brings up some of that spending and capital deployment. Again, just strengthening the trajectory of the market in 24.
George, you're not convinced. You don't think a soft landing happens. You might be one of the few at this point.
Yeah, look, and here's the reason why. Because financial conditions do matter, and they've proven to work wonderfully in the last 2 months. But we've also gone from narratives every 2 months, right? Every 2 months we flip a narrative. The time is due for another narrative. We're starting the new year. And look, if rates were to back up here, a lot of these sort of positive stories kind of get put back on the back burner. And I'm not challenging the medium-term prospects of all these great innovations, but rates do matter. The cost of capital is important, and I think that we are now embedded like a perfect kind of setup. You have to see the Fed deliver what the bond market wants. And if they don't, I think other markets are going to suffer more for it.
What about the consumer piece of this, George? And specifically what happens after the holidays, after Christmas? How much discounting do we need to be concerned about, and perhaps inventories left over and how those get treated?
Look, that's a great point. And that's why the March cut is so critical. And look, we've been one of the first strategy houses to have that call, and I'm nervous with that call because I think that they can get pushed back if we get better data in the first 2 months. But for it to actually realize a March cut to really start the actual process of the Fed getting to lower rates, the data has to get a lot worse from here. So we have NFP when we get back from New Year's Eve, on New Year's Day, and so I think it has to get a lot worse from here. And be careful what you wish for, because you don't want the data to get worse to justify the Fed cuts.